The next financial crash won't just wipe out portfolios. It will quietly, permanently change what it even means to be rich. And by the time most people realize this shift has already happened, it will be too late to adapt. Somewhere right now, the definition of wealth is breaking apart, and almost no one is watching closely enough. For decades, you were taught a simple equation. Wealth meant money. More specifically, it meant assets that went up over time. Stocks, real estate, retirement accounts, businesses that scale, numbers on a screen that grow year after year. If you had enough of those, you were safe, respected, free. But what if the next crash doesn't just reduce those numbers, but exposes how fragile that entire idea really was? This video is about why the next collapse will be different, why it won't feel like 2008 or 2020, and why the people who think they are wealthy today may discover they were only liquid in a system that no longer works the same way. By the end, you'll see why wealth in the future won't be measured by what you own, but by what you can still control when everything else starts slipping away. At first glance, everything looks familiar. Markets rise, markets fall, news anchors argue, experts reassure, charts oscillate. But here's where it gets strange. The foundation underneath those movements has quietly changed. The rules that made traditional wealth reliable were built in a very specific era, under very specific conditions. Stable currencies, expanding populations, cheap energy, predictable growth, strong trust in institutions. Those conditions are eroding simultaneously, and crashes behave very differently when the ground itself is unstable. In the past, crashes were resets inside a functioning system. The system survived, confidence returned, and asset prices eventually recovered. If you had patience and capital, you were rewarded. But now, crashes are starting to look less like resets and more like stress tests. They reveal what actually holds value when pressure is applied. And the uncomfortable truth is that many things we call wealth today only exist because everyone agrees to believe in them at the same time. Think about how quickly confidence can evaporate. A bank looks solid until it isn't. A currency feels stable until it doesn't. A stock price represents future earnings until the future itself becomes uncertain. The dangerous part is that most people don't realize wealth is not a thing. It's a relationship between trust, time, and systems. When one of those breaks, the numbers stop protecting you. But here's what nobody tells you. The next crash won't announce itself as a crash. It will begin as a slow realization that the old guarantees no longer guarantee anything. Inflation quietly erodes purchasing power. Liquidity dries up where you assumed it would always exist. Assets become harder to sell at the moment you most need flexibility. And suddenly, being worth $1 million on paper doesn't feel the same when that million can't buy what it used to, or can't be accessed when timing matters most. To understand why this matters for you personally, you need to look at how wealth was defined in the last 50 years. After World War II, wealth aligned neatly with growth. Economies expanded. Productivity increased. Debt worked because tomorrow was reliably bigger than today. If you owned appreciating assets, time was on your side. Even mistakes were forgiven by growth. This created a generation-wide belief that wealth naturally compounds if you just hold on long enough. But here's the turning point. Growth is no longer guaranteed. Demographics are shifting. Globalization is fragmenting. Energy is more expensive. Debt levels are extreme. Governments are stretched. When growth slows or becomes volatile, the old compounding logic breaks. Assets don't just fluctuate, they reprice based on new assumptions. And when assumptions change, entire categories of wealth can lose relevance very quickly. This is where the next crash becomes redefining, not just destructive. Because it will force a question most people have never had to ask before. What is wealth when markets don't reliably recover? What is wealth when money itself is being diluted? What is wealth when access, not ownership, becomes the bottleneck? Imagine two people during a crash. One has a high net worth tied up in assets that cannot be easily moved, sold, or adapted. The other has far fewer assets on paper, but high flexibility, skills that transfer across environments, strong networks, and low dependency on fragile systems. On a balance sheet, the first person looks rich. In reality, the second person often has more real power. This is the dangerous part. Traditional metrics like net worth are backward-looking. They measure what worked under old conditions. They do not measure resilience. They do not measure optionality. They do not measure how fast you can respond when rules change mid-game. And crashes are moments when speed and adaptability matter more than accumulated value. Think about 2008. Many people technically remained wealthy, but lost access to credit, opportunity, and mobility. Their assets existed, but they were frozen. Others, with less money but more flexibility, were able to pivot, acquire skills, change locations, start new ventures, and recover faster. The crash didn't just redistribute money. It redistributed power. Now scale that idea forward. In a world where systems are more complex and more interconnected, shocks propagate faster. When one part breaks, others follow. Supply chains, energy markets, currencies, labor markets, digital infrastructure. Wealth that depends on everything working smoothly becomes fragile. Wealth that depends on your ability to function under disruption becomes dominant. This is why the next crash will redefine wealth around control instead of accumulation. Control over your time. Control over your skills. Control over where and how you live. Control over your dependencies. If your lifestyle requires everything to go right, your wealth is brittle. If your lifestyle can function when things go wrong, your wealth is real. Ask yourself a hard question. If your primary income source disappeared tomorrow, how quickly could you replace it? If your savings lost significant purchasing power, what would still hold value in your life? If your location became unstable or unaffordable, could you move without collapsing financially or emotionally? These are not abstract scenarios. They are stress tests for modern wealth. Here's where it gets even more uncomfortable. The next crash will blur the line between economic and social stability. Wealth used to insulate people from chaos. In the future, wealth that is purely financial may not. Communities, trust networks, local knowledge, and adaptability will start to matter more than abstract numbers. You cannot outsource resilience entirely to a portfolio. This doesn't mean money becomes irrelevant. It means money becomes insufficient on its own. Financial capital without human capital and social capital becomes weak under pressure. And the people who don't understand this will feel betrayed, not by markets, but by the promise they were sold. The climax of this shift happens when people realize that safety no longer comes from being ahead in the old game, but from playing a different one entirely. A game where wealth is the ability to absorb shocks, not just avoid them. Where success is measured by how many options you have when conditions change, not how impressive your balance sheet looks during calm periods. Picture the next crash not as a single event, but as a series of overlapping stresses. Markets drop. Inflation persists. Governments intervene. Rules change. Taxes shift. Capital controls appear. Access becomes conditional. In that environment, wealth is the ability to remain calm, mobile, useful, and connected. It is the ability to say no to bad choices because you are not desperate. And this is the hidden truth. Crashes don't destroy wealth evenly. They expose illusions. They reveal which forms of wealth were borrowed from stability and which were built for instability. They punish leverage and reward flexibility. They humble those who assumed permanence and elevate those who prepared for change. So what does this mean for you right now before the crash arrives? It means rethinking wealth as something dynamic, not static. It means investing not just in assets, but in yourself. In skills that cannot be easily automated or devalued. In relationships that provide information and opportunity. In reducing dependencies that limit your freedom under stress. It means asking whether your version of success survives disruption. Whether your identity is tied to numbers that could disappear or capabilities that move with you. Whether your confidence comes from external validation or internal competence. These questions are uncomfortable because they challenge the story we've been telling ourselves for decades. The people who come out strongest after the next crash won't necessarily be the richest today. They will be the most adaptable, the most grounded, the least surprised, They will understand that wealth is not about winning a single system, but about staying functional across many systems. In the end, the next crash will force a collective redefinition. Wealth will no longer mean how much you have. It will mean how little you need to function well. How many doors remain open when others close. How much agency you retain when the environment becomes hostile. If this perspective feels unsettling, that's because it challenges a comfortable illusion. But it also opens a powerful opportunity. Because if wealth is changing, you still have time to change with it. And if this opened your eyes, stay with us. This story isn't over yet. Subscribe and be ready before the definition shifts again.